Natural gas prices continue its freefall on Friday on the wave of bearish mood around energy markets as easing Middle East tensions and a looming global supply surplus weighed on the market. Israel approved a framework for Hamas to release hostages in exchange for prisoners, marking a major step toward a peace deal in Gaza. U.S. natural gas futures fell about 4% to a two-week low, driven mainly by milder weather forecasts and high storage levels. Warmer than normal conditions through late October are expected to suppress heating demand, offsetting minor increases in cooling demand as power sector gas use declines. Gas output in the lower 48 states averaged 106.4 billion cubic feet per day so far in October, slightly below September's 107.4 billion cubic feet per day but still close to record highs. Storage levels are about 4% above the 5-year average, easing concerns over winter supply. Total U.S. gas demand, including exports, is projected to dip slightly from 100.6 billion cubic feet per day to 100.3 next week before rising to 103.3 billion cubic feet per day in 2 weeks. LNG feed gas flows increased to an 8-week high of 16.5 billion cubic feet per day, supported by rising activity at Venture Global's Plaquemines facility and Cheniere's Corpus Christi plant, while Cove Point remains shut for maintenance. Despite this export advantage, solid domestic storage and mild temperatures continue to cap upside potential. Cash prices at hubs such as Waha and ECO remain weak, hovering below $1 due to pipeline maintenance and regional bottlenecks. Technically, the November contract settled near $3.11, its lowest close since late September, marking a 6% weekly loss after a sharp rise the previous week. The failure to sustain gains above the $3.30 threshold invited renewed selling pressure, pulling prices toward near-term support around $3.10. A clear break below $3 could expose the next target near $2.90. Meanwhile, the March-April 2026 spread continues to narrow to a record low of about 11 cents, signaling market confidence in ample winter supplies and reduced speculative interest. The overall technical bias remains bearish unless buyers regain the $3.30 resistance zone with conviction, which could trigger a short-term rebound toward $3.50. Please don't forget to comment, watch the previous video, and show some love for the channel. See you next time.